Imagine you're a hunter. Every day, you walk into the forest looking for food. You have two choices. The first is a deer standing 20 meters away. The second is an eagle flying 200 meters above your head. Which one are you more likely to catch? Most traders don't realize it, but every trade they take is making this exact decision. And this is why so many traders fail with a 1:4 risk-reward strategy while believing they're being smart. Today, I'm going to show you why 1:2 risk-reward often outperforms 1:4 risk-reward in the real world, and why 1:1 isn't the answer either. Let's begin. Most beginner traders become obsessed with finding the biggest winner possible. They hear someone say, "Just risk $100 and make $400. Suddenly, the 1:4 risk-reward ratio becomes the holy grail. It sounds logical. It sounds professional. It sounds intelligent. But the market doesn't reward what sounds intelligent. It rewards what is repeatable. And that's where the problem begins. Because a 1:4 target is not just twice as hard as a 1:2 target. It's exponentially harder. Think about it. Price can move 100 points in your direction and still fail to reach your target. Price can be correct. Your analysis can be correct. Your entry can be correct. And yet you still lose because your target was simply too far away. Many traders spend years confusing being right with getting paid. The market doesn't care. Only completed trades matter. Now let's look at the opposite side. The famous 1:1 risk-reward ratio. At first glance, this seems safer. You don't need huge moves. Your win rate becomes higher. You get rewarded quickly. Your brain loves it. But there is a hidden danger. Imagine winning 10 trades and losing 10 trades. At 1:1, you're basically standing still before fees, spreads, and mistakes. One bad emotional trade can erase several good ones. A small drop in accuracy can destroy profitability. You're working hard just to stay in place. Like running on a treadmill. Lots of effort. Very little progress. Now enter the 1:2 risk-reward ratio. The middle ground. The sweet spot. The place where mathematics and human psychology finally shake hands. A 1:2 target is far enough to make meaningful money, but close enough to be reached consistently. This creates something most traders underestimate. Momentum. Not market momentum. Trader momentum. When you see your targets getting hit regularly, confidence grows. Discipline improves. Execution becomes cleaner. You stop forcing trades. You stop chasing impossible moves. You begin operating like a professional. Here's what many traders never understand. Professional trading is not about maximizing profit per trade. It's about maximizing profit over thousands of trades. Those are completely different games. A casino doesn't care about winning the most money on a single customer. It cares about having a small edge repeated thousands of times. That's why casinos become rich. Consistency beats intensity every single time, and a 1:2 risk-reward ratio fits this philosophy perfectly. It provides enough reward to grow an account while maintaining realistic probabilities. Think about two traders. Trader A targets 1:4. Trader B targets 1:2. Trader A catches occasional huge winners, but watches countless trades reverse before reaching target. Trader B captures smaller but more frequent gains. Month after month, year after year. Who survives longer? Usually Trader B. Because survival is the first rule of trading. You cannot compound an account that no longer exists. The irony is that many traders choose 1:4 because they want freedom faster. But the larger target often creates more frustration, more missed opportunities, more emotional damage, more revenge trading. The strategy looks amazing on a spreadsheet, but trading is not performed on spreadsheets. It's performed by human beings, and human beings have emotions, fear, greed, impatience, A strategy that ignores psychology is incomplete. So does this mean 1:4 never works? Of course not. There are traders who successfully use larger risk-reward ratios, but they usually have exceptional patience, exceptional discipline, and strategies specifically designed for capturing massive trends. Most retail traders are not operating under those conditions, and that's okay. The goal isn't to look impressive. The goal is to make money consistently. So here's the lesson. 1:1 often leaves too little room for growth. 1:4 often demands too much from the market. But 1:2 sits in the middle. A balance between ambition and realism. A balance between mathematics and psychology. A balance between profit and probability. And in trading, balance is often where the real edge lives. Because the trader who survives and compounds for years will almost always outperform the trader who spends years chasing the perfect trade. Remember, the richest trader is not the one who catches the biggest move. It's the one who keeps collecting good moves long enough for them to become extraordinary.